Welcome to the Daily Update, where I'll go over the action in the market for Thursday, March 16th, and then we'll see how things look for Friday, March 17th. Happy St. Patrick's Day. We had a pretty significant bounce. Not enough to really shift things back positive, but it could be the start. We have to ask, are we starting to come into that positive seasonality that we've seen historically? We're not really seeing an awful lot of confirmation yet on the charts, although we're starting to see some improvement. So now we have to see, can this carry on, or is this just an anomaly within the context of a bigger downtrend? So let's go back and talk about what happened. Right at the open, we had a gap lower open. It looked like Thursday was just going to be another day like Wednesday, where we just kept going down and down and down. Things started out pretty grim. We went down below the daily pivot at 38.75. Then, all of a sudden, prices started to rebound. We got back above the daily pivot. We went above the unchanged level, went positive. We got above R1 at 39.11, then R2 at 39.31. We even broke above the 200-day simple moving average. I was watching that. We kind of came up to it, stalled out a little bit, went sideways, and then finally were able to break above that. And then we closed above S2 just below the high of the day. So it was pretty positive, but we don't really know the context of this move currently. We were up 1.76% on above average volume, so that's pretty healthy. The technicals are still negative overall, but we're showing some improvement, and I have lots of charts to show you. A lot of this has to do with this banking situation, where it seems like that's putting the market at ease for right now. We don't know what the longer-term ramifications are going to be, but at least some Fed officials, and even in Switzerland, they're willing to step in and cover the deposits in the bank. But now you're seeing a lot of folks starting to get out of banks that may not be labeled as a safe bank right now and putting their money in these more risky banks. What's that going to do to the overall situation? So we're still watching the situation to see, is there a contagion that's going to happen, or has it now been dealt with as it drifts out of the news cycle? Here's the intraday chart. We did have a lower open. Didn't gap all that much, but we came down below the daily pivot, and it looked like, okay, we're just going to start heading lower and lower. Well, we stabilized at this level, got back above the daily pivot, went above the unchanged level, got above R1, and then eventually R2. We stalled out right here a little bit. Is it going to pull back down from the 200-day simple moving average, or is it going to break through? Took a little bit of time, but it did break through. We got up above the 39.60 level before we're going sideways and closed pretty much at the high for the session. This is a new chart just showing the relationship between value and growth. This is a 10-minute line chart where the blue line is growth and the red line is value. And we can look at this over a period of time. A lot of times what I show you in these videos are just end-of-day values. Well, how is the relationship going as the day goes on? I pointed out that growth was doing better than value back on Wednesday, and you can see the blue line was above the red line, and this was adding a positive backdrop to the market, and it ended up leading the way even higher. So maybe this will give us some additional insight. Another interesting chart is the SPY. What happens when the market's closed? If you look over here in this pink area, might be a little hard to see, this is right after the stock market closes and then goes up till about midnight Eastern time. And then it switches over to a light bluish area during the night. And so when I'm talking about the futures, we're up, down, whatever. Well, the S&P is tending to follow that as well, where they had been drifting lower, which gave us a lower open. But then we saw a lot of strength after the market opened. And then we closed after Thursday's session. And this is so far the overnight trading session to give us an idea of where the futures are at. Again, just to give us more information, more insight to be aware of what's happening, what are some comments that we can make? The European Central Bank did raise their key policy rate by 50 basis points, and they're citing inflation and that it's projected to remain too high for too long, so they have to bump up interest rates. Then there was a Wall Street Journal report that highlighted a potential private sector solution to deal with one of the other banks that's on this watch list right now, this First Republic Bank. And it suggested that the big banks might come in with a capital infusion for the smaller First Republic Bank. This ended up helping stocks find support and then rebound from that level because it was confirmed that 11 banks will make uninsured deposits of $30 billion into First Republic. Later on in the day, this article was pretty much confirmed where it said that 11 of the really big banks will make uninsured deposits of $30 billion into First Republic. Later, Treasury Secretary Yellen came out and told the Senate Finance Committee that Americans can feel confident that their deposits will be there when they need them, which, as I said a minute ago, maybe that's making some folks get out of banks that are doing okay right now, putting them into one of these risky banks where the Fed says, don't worry, we've got you covered. Now they can put as much money as they want into this bank that's not always insured, but now they know it will be insured, so that has a potential of backfiring on folks. I'm not saying that's what will happen. It's just something for us to watch out for. The market seemed to like this because this was a private sector-led solution. The market tends to like that, at least in this case, and so that gave a lot of support for stocks going higher. We still have our longer-term stochastics that's looking extreme negative. It hasn't turned up yet. On an intermediate-term basis, our PMO study and our BPI are still extreme negative, but other than that, we've worked off this oversold condition. The dollar was down and interest rates were up, which usually would give some headwinds to stocks, but in this current environment, this is what stocks needed. Then we have the 30 to the 5 that's back to being inverted again, so all of our yield curves remain inverted. Our sentiment is still negative. It ticked up with the up day. It's at 29 where it had been at 28. Our trend is still negative, and it is strengthening, although it's starting to roll over with the up day. The red line's starting to come down, the green line's starting to go up. But again, we're below 20. I've switched our bias to positive with the up day, and I've switched our momentum back to mixed because we've had a lot of down days that were pretty significant. But yet this up day, now we have to see, can the market build upon that? So what are the economic reports that came out? Weekly jobless claims came in lower than expected at 192,000. They had expected 215,000. Last week it was at 212,000. Housing starts were more than expected at 1.45 million. They expected 1.313 million. Last time it was at 1.321 million. Building permits were also up at 1.524 million. They expected it to be at 1.345 million. Last time it came in at 1.339 million. And this can be a leading indicator of the economy. So the fact that building permits are going up does suggest, at least in the housing market, that things are still staying strong and going up. The Philadelphia Fed Index, this was weaker than expected. It came in down 23.2. They expected it to be down 13. Last time it was down 24.3. Import and export prices are next, and they're not a real big impact on the market, but it's still good to know these things. Import prices came down 0.1%. Last time they were down 0.4%. When you take out oil, they were up 0.4%. Last time they were up 0.2%. Exports were up 0.2%. Last time they were up 0.5%. If you take out agriculture, they were up 0.1%. Last time they were up 0.6%. Then, just to update, where are we with the Fed? Next week will be the Fed meeting, so we want to keep an eye on that. The Fed officials are likely on lockdown now, so they won't be giving any interviews or speeches or things like that. So we just have to look to the market as to what might be happening. Going back to March 3rd, they were looking at a 71.6% chance that they will raise rates 25 basis points. Then Chair Powell came out, gave his testimony before Congress. That immediately switched to 50 basis points. As of right now, we're back down to the 25 basis point camp, and it's looking pretty strong at 86.4%. There's still 13.6% of folks that are expecting that they may leave rates unchanged. Looking at the weekly jobless claims, we're showing how it's coming down. The moving average is starting to roll over just a little bit, and then the continuing claims also came down, showing that we have a pretty strong labor market. We had the latest reading of the American Association of Individual Investors. Not to be surprised by this because we had a down Friday last Friday, and so they reacted to that, and they are extreme negative, which could give some support to the market, but this data is about a week old. Also, the Ultra Index is a little bit above the moving average, not really helping us or giving us a lot of insight currently. Here's the VIX with the update. We were down on the line chart and on the bar chart. And the VIX of the VIX shows that volatility is decreasing. The equity put call ratio also declined, not surprising. Looking at the 5-period moving average, we're still at about that 0.8 level. Here's the longer term chart. And when we get to a high level like this, sometimes that marks a bottom in the S&P. That's one positive sign that we're looking at. Can the market capitalize on this? We've been at this level before, only to have it just fizzle out after the market tried to go up. Looking at our trend, see how the ADX is starting to roll over, but it's still above the moving average. The red line is coming down, the green line is going up. We're still in a trendless environment because we are below 20. The daily chart shows we were finally able to get above the 200-day simple moving average and close above that. So that switched our long-term stance to being more positive. And then on the bottom, we see where volume has really picked up. Here's a 2-year look at that same chart, just showing some improvement currently. This is encouraging, but we need to see follow-through for this to turn more positive. We have to get back up to the 50-period moving average and then close above that, and then eventually get back up to this pivot level. Above that pivot level would turn things for the month more positive. The Arun shows that there's a decrease in sellers and an increase in buyers, so after giving us an extreme negative reading, our oscillator's starting to turn back up, so it's no longer extreme negative. Here's value and growth showing where growth was up more than value, both for the large caps, the mid caps, and as well with the small caps. The stochastics going above the dashed line here, so in the short term we're turning more positive. We're still negative but showing improvement in the intermediate term. We're still extreme negative but turning up in the long-term stochastic chart. The force index crossed above 0 and is now turned back positive. We're starting to get back up to this 20-period simple and exponential moving average. Right now that's acting as overhead resistance. If we can get above that and close above that, that would turn things more positive. Here's the 100-period moving average. We're right in between the simple and the exponential moving average. And here's our moving average tree. So now we've regained the 200-period moving averages. Now we're starting to battle the 100 moving averages. The slope, this is one of our oscillators. It's starting to turn back up. This is probably the most touchy indicator of all the oscillators that we use. Here's all of our oscillators with the slope on top that I just showed you. We're turning up slightly with the TSI. The MACD showing some improvement, but still negative, as is the PMO, the PPO, where our longer-term oscillators, the TRIX and the KST, continue to show a decline. The parabolic SAR is still negative with the dots on top. Chaikin oscillator, this is something that we pointed out in yesterday's video. We were looking a lot better. Now we've crossed above the 0 line and are advancing, so this indicator has actually turned positive. Our PMO study, we're starting to advance after being extreme negative with the percent of PMOs that are rising. The buy signals are still extreme negative, but showing some improvement. We're still declining with the percent of PMOs that are above 0. Bullish percent index continues to be extreme negative below 30. Ticked up just a little bit, but didn't really participate in the advance. The NYSE bullish percent index continues to decline, so this is a broader look where this is still declining, but not extreme negative. Chaikin money flow showing some improvement. We saw this in yesterday's video. We're not positive yet, but we are turning back up. This just tries to measure institutional buying and selling, and this could show that the institutions are starting to come back in. Balance of power, right at the dash line here, just slightly positive. This also started to turn up before we saw price turning up. TTM squeeze also showing some improvement. Still negative, but we have the lighter shade of red here, and the lines are going back up on the histogram. The go, no-go system, after being deep purple, is now switched back to neutral purple. We came down to this anchored moving average at the COVID low, and that seems to have provided some support, even though we fell a little bit below that. But we're bouncing up off of that currently, and we're above the 200-day simple moving average. Haven't seen that in a while. Here's our short-term fib level. We broke above these resistance levels. We still have some other resistance at about the 4,004 level if we continue to go up. Here's a chart that I didn't show for a few days because we were just drifting lower with no man's land. We're coming back up, which also could be at about the 4,000 level if the S&P continues to climb. Our longer-term chart, if we continue to go up, we're looking at resistance at 4,020. If we continue to fall, we're down around the 3826 level. Here's the weekly chart showing how we have been able to hold up above support and are bouncing up off of that, and we're well above the 200-week moving average. Elder Impulse System has switched back to positive for the S&P. McClellan Oscillator still negative but showing improvement. And the McClellan Oscillator for the NYSE, it's still negative but showing some improvement. The summation index still continues to decline based on price and volume. New highs, new lows, we're still declining with the 5-period and the 10-period. And you see, even with the update, we didn't see a breakout in the new highs. We're showing some improvement with the advanced decline line, but we're still below the moving average based on price and volume. This is another thing that I pointed out yesterday where we're above the moving average and advancing, so that's just showing more improvement. Volume continues to pick up, and the financials to S&P 500 ratio still really down overall, but ticked up ever so slightly. The bank ETF, which has just been getting hammered, was up 3%. The regional ETF up 3.5%. Another regional ETF was up 3.5%. Looking at the ratio between the regional banking sector and the financial sector, it is showing a little bit of a bounce after going down pretty far, pretty fast. Here's the S&P 500 to the equal weight, showing that the big companies are still outperforming the smaller companies, and this could give some good support to the market. The KG chart has switched back to positive. We have a black line after switching from red. The Dow still has to go up a bit to get to its 200-day moving average as well as its 50-period moving average, but showing some improvement after bouncing up off of this S2 level. The diamonds are neutral. The NASDAQ getting close to a golden cross, came back up to the pivot and closed just above that. So this is where we've seen the real strength over the last few days, is in the NASDAQ and the NASDAQ 100. Also, this broke above the pivot and has given us a golden cross. So this is turning the bigger stocks in the NASDAQ more positive. Here's a look at the fib charts, where if we do continue to go up, we're looking at about the 12,868 level as upward resistance. The Qs are positive with green bars based on the Elder Impulse system. Small caps, which just got hammered, showed a little bit of a bounce here, but still below a lot of pivot levels. And here's another look at the Russell 2000 small cap index, where we came down to this support level and so far have been bouncing up off of that. The RSI, based on 9 periods, has been extreme negative and is now starting to show some improvement. But if you look at the MACD at the bottom, we're still in a decline. Small caps are neutral, even with the update that we saw. The small cap ratio to the S&P still continues to break down. This is more negative for the S&P, where the other things I'm trying to point out are more positive. The mid caps also rebounding after really going down hard. And with the Elder Impulse system, they are only back to neutral. Looking at the home builders, where the S&P has been going down but bounced, the home builders went down, bounced a little bit. The ratio's been holding up okay, but now we're starting to see this relationship get stronger again. So if the home builders are going up, the S&P is going up, they're confirming each other. We didn't get this positive divergence like I had been watching for. Copy curve, generating a buy signal. We're starting to see a crossover here, so that's positive. And the stock to bond correlation shows that stocks and bonds are having a real strong tendency to go in opposite directions. If stocks are up, bonds are down, and vice versa. Looking at the 10-year bond yield, after really coming down strong, did bounce back up. We're still below 3.6%. And here's bond prices really shooting up, have since fallen back. We're still in an overall uptrend. The RSI has pulled down a bit, but the MACD continues to be positive. And then our fear gauge, after really going up, has come back down just a little bit. Looking at our long term, we're still a little bit suspect here. We're going to have a good solid Friday for this weekly chart to try to turn this MACD back up. We're really in danger of crossing below, which if that happens and then continues to fall, it would suggest that this breakout above the trend line was a fake out. But right now we're back above the trend line, so that could be positive. Can we hang on to that in Friday's session? An update of our possible positive scenarios. This is more the positive backdrop I was showing, where the Qs against the S&P have been going up, seeing a little bit of improvement with discretionary against the S&P, and large cap growth has been really outperforming large cap value. And then here's the large caps, mid caps, and small caps outperforming. So that's more the positive backdrop we're seeing. Looking at our 19-day exponential moving average of the advanced decline ratio, we did get an extreme negative reading, and we're starting to bounce back up based on price and volume. Sometimes that gives pretty good support to the S&P. Will that happen this time? Then looking at the broad measure, the Amex, NASDAQ, and NYSE, we're still below the zero line when we look at the highs minus the lows and then take a 5-period moving average of that. So that hasn't turned up yet, but this is a 5-period moving average, so it's a little bit delayed. Then our 50-period exponential moving average of the new highs minus the new lows, this is dropping below zero now. So this could be longer-term negative. And here's the indicator showing that we're below zero, and the longer we stay below zero, the more that 50-period line moves down. But on a positive side, we're looking at this 2-year spike that is now really coming back down. Is that going to give some support to stocks? And then our staples to S&P 500 ratio coming back up, but we're still working off of this spike right here. If this continues to fall, which it did in Thursday's session, that could give some good support to the S&P to go higher. But we've seen a lot of this to see the market go up and then fizzle out. We want to see some really good strength. So what's our outlook for Friday? The technicals are negative and possibly bouncing. Well, they have bounced already. What I'm suggesting here is, can this bounce continue? Friday is March triple witching. So we have a lot of different option contracts that will be expiring. So this can really lead to some craziness in the market at times. The economic report's coming out. We have industrial production and capacity utilization, as well as the leading indicators, and then consumer sentiment. The geopolitical events, yes, we're keeping an eye on the whole Russia-Ukraine situation. The markets are fixated on this inflation and interest rate scenario, but we're also keeping an eye on this whole banking thing that's going on. Is there another shoe that will drop at some point? Looking at the Stock Traders Almanac for Friday, we're up pretty much across the board, with the Dow and the S&P being up 66.7% of the time, and the NASDAQ is even stronger, being up 71.4% of the time. And then all the other things that are adding to the positive backdrop that we need to see kick into gear. Then here we are in the 13th trading day of the month. This is options expiration. Looking at the green dash line, we do see an upward movement. So this is adding some positive seasonality. And then can we continue to go up to get into this pre-election after midterm bear, this gray line, which for the most part tends to go higher in the month of March. And then we're also in this period, what is supposed to be this sweet spot for the S&P. Can the market continue upon what has historically happened? Looking at our scenarios, you could technically go with the down scenario because we still have a lot of our charts that are negative, but we'll need to see a real downward movement for that to happen. So the technicals are negative, but we're possibly bouncing. The thing is that bounce going to continue? Can't really go with the up one yet. We're still looking quite negative technically right now. We're still below 20 with the ADX, even though it is weakening slightly. The red line is still on top, even though it's declining. So we still default to the sideways trend. So our conclusion, the S&P is negative and possibly bouncing. Again, if that can continue, we're seeing some improvement in the short term as well as the intermediate term. Long term, we've switched back to positive now because we're above that 200-day simple moving average, and we had a recent golden cross. Thank you. I hope you found this helpful. I will be preparing the daily video for Monday's session, as well as the weekly video, the intermarket analysis video, the deep dive video, and the supplemental video. So I will talk to you in the next video that you listen to.